Holiday shoppers, beware. Hey everybody, you're watching Bull Boom Bear Bust, back with another dose. BX4 back in the building. More economic reality, folks. Holiday shoppers, beware. What does that mean? Well, store credit cards are doing something very, very interesting. And we're going to talk about that here in just a few minutes. But we have a lot of economic, financial news to get caught up on, as usual. And let's go ahead and get started right here. Buy now, pay later. More popular than ever, but it can cost more than you think. And we're going to talk about the outrageous move that store credit cards are making, right? But the buy now, pay later is more than store credit cards. It's a lot of different apps out there now that allow you to buy something and have 4 easy payments, 6 easy payments. If you bought something on eBay, you've probably seen that. If you buy something, pretty much any online retailer offers that. Not any, but a lot. And a lot more than before. And these buy now, pay later financing schemes are not put into people's credit, right? So it's not reported negatively as other types of debt would be. So it's very interesting, all the new ways they're coming up with to keep this consumer-driven economy from imploding. Remember, as soon as the new schemes are done, then this economy is finished. It comes crashing down, folks. So they always have to find new ways. Look at the housing market. Look at all the down payment assistance programs. Look what they're doing now with the buy now, pay later programs and these apps. So new ways to keep people spending money, getting further and further into debt. We're already way beyond where we were at the peak of the 2008 financial crisis. So the average person is in much deeper debt now than before, and a larger percentage of the population is deeper in debt than ever before. So it's more debt, 1, and it's a bigger portion of the population, 2, and more debt. But yet the banks have been given a lot of basically freedom to keep loaning out money. And folks, this is the backbone of the U.S. economy, keeping consumers spending money and enabling people to borrow more money. And of course, more programs and assistance, more apps to help people finance things and buy things that they normally would not buy. But this is the calm before the storm. Now, we looked at the last few months as a possible breaking point of the U.S. economy. We talked about the fourth quarter, the second half of the year being the time when markets typically fall apart. We're seeing the markets very strong right now. Dow Jones, S&P 500, new record set actually in the Russell 2000 just recently. But I think it's the calm before the storm, folks. And I've said that October could have been a month where things fell apart. But I said if the banks were given new rules as far as how they can loan out money, that didn't happen, folks. I've got an update for you on that. The banks still have a reserve ratio of 0% here. Let me bring up some information on that for you. And what did I tell you right here in this channel when they first started talking about implementing these tighter rules, capital rules, and reserve requirements for the banks? I said I'll be very surprised if they do that right before November, because we had the events there, the selection or the pick of who is going to be the quote-unquote leader. And of course, we were correct. They didn't do that. If you look here, folks, bring up a chart here, the reserve ratio still at 0% for the United States. Some countries actually have a much higher reserve requirement because they've already seen massive inflation problems. Look at right here, 73% Venezuela. That means for every $100 they loan out, they have to have $73 in reserve. The United States, 0, folks. So they can loan out $1 million literally and only have $1, not even that, in deposits. It's insane. It's off the charts. It's bonkers. Pick your descriptive word for it. But that's what's happening. But it's not just the U.S. Turkey, very low, 8%. Vietnam, 3% reserve ratio. Let's see here. 50% in Nigeria. They saw massive inflation problems, so they had to bump it up there at 50%. Let's find some other ones. It's hard to find country at 0%. France, 1%. Greece, 1%. Germany, 1%. Brazil, 21%. That's kind of high. They saw massive inflation problems there as well. So, folks, you get the game. It's not just the United States. It's not about who's on TV giving the speeches, pretending that they're running the economy. There are going to be some massive shifts coming up, though, in the very near future with tariffs. And we're going to talk about that here in a bit. But I think it's going to be inflationary. I'm going to tell you why. I'm not just going to say it's a guess. I'm going to give you my facts and my opinions on why I think it's going to be inflationary. But what do you think about this? The banks, reserve requirement 0. So do we ever have to see a stop in inflation? Do we ever have to see the markets come down? Gross domestic products not going to drop if people can still borrow more money. But the question is, how long can people maintain this debt and keep paying these elevated debt payments with the high interest rates, right? We're going to get into that here in just a few minutes as well. Now, before we get to that, let's talk about what's happening in the used car market. We're seeing prices in mid-November compared to November 2023. Prices are dropping, particularly in electric vehicles. Electric vehicles down 11%, folks, year over year. We see pickups down 2%. Some vehicles actually up year over year. Mid-sized cars are up 1%. When you average everything out, it's still up about 0.5% year over year. So much for more affordable cars. But I think we're going to continue to see a downward trend in the price of vehicles unless, and this is a big one, unless they come out with some sort of special scheme like they do in the housing market, such as down payment assistance. Does anyone remember cash for clunkers? Remember how that spiked the car sales and also prices went up at that time briefly? Nothing like we saw, though, in 2020 with all the stimulus checks, the cancellation of all these payments, cancellation of rent, stoppage of foreclosures, all the intervention in the economy that led to the high cost of living, much higher now than what it was a few years ago. So, folks, what do you think about this? Electric vehicles, the big drop, 11%. We just talked in our last report about how many electric vehicle owners are finding it more expensive for the electric vehicle when you look at the cost of insurance, folks. A lot of insurance companies don't want to pay for the repair of an electric vehicle because you can only go to certain shops. You have to go to specialized Tesla shops, for example, if a Tesla vehicle gets in an accident. There's more shops opening up and becoming compatible or becoming more able to repair electric vehicle damage, but it is much higher on an electric vehicle as far as insurance goes, but other costs as well. Some people report that they are saving a lot of money with their electric vehicle when it comes to just the cost of gas, right? So it's kind of a mixed bag, but when you look at the declining price, I could see that the popularity looks like it's waning pretty heavily for electric vehicles. Speaking of a spiking cost of living, more than 60% of low-income Americans now consider fast food a luxury. Fast food a luxury. I talked a few days ago about how I went out of town for about 3 days with the family and ended up eating a lot of fast food just because that's what was there. That's what was nearby the hotel. And it was an average of between $20 and $35 per meal for a family of 5, which really is not bad. But look at this. 60% of low-income Americans consider fast food a luxury that they can no longer afford. The College Group released its findings this month as casual restaurant chains that had long attracted working-class families have hiked menu prices since the pandemic to offset rising labor and production costs. The research firm surveyed nearly 5,000 consumers aged 18 to 78, including 2,300 people that earn less than $50,000 a year. The other 1,700 or so earned between $50,000 and $150,000, and 337 earned $150,000 or more. But 60% of the lower income group said they can no longer even afford fast food. So these people are going to the grocery store. I would say they're going to the 99-cent store, but the 99-cent store went out of business with them. Still kind of shocked at that because I thought that would be one of the big places that would thrive during this high cost environment. Just like my Dollar Tree, I thought the Dollar Tree was going to really spike and the stock kind of sank. So that was one of my losing picks. I don't just share the winning stocks with you. I've had a lot of winners over the past few years because I'm very selective on the stocks that I invest in. But Dollar Tree was a big loser for me. So I'll at least admit when I lose money, just so you can learn from my mistakes. Did you also lose money in a stock that you thought would thrive during this inflationary environment? Right? Dollar Tree is one of the only stocks that really lost bigly for me. I've broken even on a few, but I've gained more than I've broken even on. So I'm still ahead, but I'm still kind of shocked at the Dollar Tree. And I'm shocked at the 99-cent store not even making it throughout this economy. Moreover, on these food prices here, folks, over the past 6 months, 34% of lower income survey respondents reported spending less on quick service restaurants. By contrast, 28% of middle income and 18% of high income adults reported doing the same. The survey found 24% of low income earners plan to spend even less on fast food in the future, compared with 21% of the middle and 12% of high earners. Fast food used to be a go-to for lower income Americans to save money and time. It's no longer that, folks. That's sad when McDonald's is considered a luxury for most of the people making less than $50,000. That's really sad to me, folks. But where there's cause, there is an effect. McDonald's to expand U.S. value menu as fast food chains battle for bargain seekers. So as people finally said no thank you, look what's happening now. The bargains are coming back. The dollar menu and the value meal menus are coming back to a lot of these restaurants. Now let's apply that on a larger scale. If people on a larger scale would say no to the high rents, no to the high home prices, no to just the high cost of everything, stop going further in debt, folks, and basically backing these higher prices, right? When you go further into debt to buy something, the prices are not going to come down, folks. And that's why we always look at the banks, how much money they're loaning out, how much debt people are taking on to keep this spending going. And we're entering a very, very interesting holiday season here. And we're going to talk about a warning that was just put out here for holiday shoppers. Take a look at this. Retailers, very tricky. Look at this. Increased credit card interest rates ahead of holiday shopping. Macy's and other major brands raise rates to record highs as inflation impacts holiday spending. So instead of making it easier for people to carry this debt, they're actually raising the interest rates. Why would the stores be doing this right now ahead of the holiday shopping season? I think because they know that shoppers are still going to spend the money. People aren't really concerned about what they have to pay tomorrow as long as they can have it today. With the holiday shopping approaching, many consumers are not just preparing for their shopping list, but also bracing for what could be a significant shift in their credit card interest rate. A wave of increases has hit the store-branded credit cards of several major retailers, according to Bankrate. Over 50 large retailers, including household names like Macy's, Gap, Big Lots. Big Lots. I thought most of them went out of business. I guess they're going to try to make some quick bucks on the way out, raising the interest rates, have hiked their annual percentage rates on store credit cards to record highs this fall. This comes at a time when inflation continues to put pressure on shoppers, making the timing completely noteworthy. The rationale behind these hikes is mainly tied to recent trends set by the central bank. Retailers preemptively raised their rates before the Fed's anticipated rate cuts. So instead of rate cuts on the credit cards like the central bank is doing, we're having rate increases. The average APR on store credit cards hit an unprecedented level, averaging more than 30%, folks. So beware to holiday shoppers, especially if you're putting purchases on these store credit cards. If you can't pay them off in full each month, you might want to think twice about where you're shopping. I'm not saying buy gifts at the Dollar Tree because whoever you buy gifts for may hate you, but, do what you're going to do. I guess if they're young enough, they may not know. They may even like some things from the Dollar Tree. Among the most significant increases, Big Lots, talking about Big Lots again, raised the APR from 29.99 to 35.99, making the highest increase among surveyed retailers. Wow. So Big Lots, they really failed big time if you ask me. They should have cut their prices just like McDonald's and these other fast food restaurants that saw decreased traffic and decreased customers. They had to adjust their prices, but every time I go to Big Lots, prices would be the same or even higher, even though the store would be empty. So to me, it wasn't even a surprise that Big Lots failed and had to file bankruptcy. But folks, that's the warning being put out there by a few different news outlets. This is out of everymajesty.com. Not sure how to say the name of the site, but that's where this particular article came from that I pulled these statistics from. Let's talk about layoffs and getting fired, folks. Out of Fortune, 90% of his staff was fired for missing a morning meeting And the CEO stands by his choice. This is out of Fortune. Who does this? Who fires 90% of their staff for missing a morning meeting? And why did so many people miss the meeting? This is very strange. Rage quitting is one thing, but one CEO has introduced a new spin on the concept, rage firing. Baldwin Addison, CEO of Wyoming-based musical instrument online storefront Musicians Club, fired 90% of his staff, which is 99 out of 110 employees and freelancers, via a Slack message for missing just one morning meeting. One former employee detailed the shocking event in a now deleted post on Reddit. I joined an internship, and an hour later, the entire team got fired. Why would so many people miss the meeting? That's what I want to know. I gave you an opportunity to make your life better, to work hard and to grow, yet you have shown me that you don't take this seriously, he went on in a rant. Out of 110 people, only 11 were present this morning. These 11 get to stay. The rest of you are terminated. Wow, he said, get the F out of my business right now. That's a quote. That's what the worker said that the message contained. Well, instruments are kind of a dying thing. I mean, unfortunately, most music made nowadays is electronic. And there are still some rock bands out there, but it's not like the 80s and the 90s and where rock and roll, rock music dominated. It's mostly dance, electronica, pop, and not even real instruments being played. There's still a lot of bands out there, but when you look at the popular music, the majority of it is just electronic music. So it doesn't surprise me that a musician instrument-based company, like we remember Guitar Center, didn't they go out of business? It's been a few years. Musicians Club. Anyways, pretty interesting, folks. What do you think about all this? The warning about these store credit cards, 30-something% interest rates on those. The bank's still with zero reserves. Debt's going to continue to accumulate. Is this the calm before the storm? Let me know down in comments. How much longer is your timeline? Do you see an implosion? Or is it going to be rescue programs to infinity? No pullback, no crisis, except for an inflationary crisis or a melt up, which in my case is a worst case scenario. A crash or collapse and a freeze up of the banks would be much better than this melt up hyperinflationary scenario that I think we're headed into. Again, please let me know down in the comments and give us a like if you like what we talk about on this channel. Make sure you are subscribed. Thank you for keeping this channel alive. Everybody keep stacking. Bye for now. Peace.